Hello and welcome back to yet another exciting week on the stock market. In this week's episode, I will walk you through the news, give an update to my portfolio, and finally answer some questions which I have received from the audience. So let's start by taking a look at the news. And if we start by looking at the unemployment rate in the United States, I go to Trading Economics, and then we have the last years of data here. So the last year, it seems like there's almost no unemployment rate because it's not really increasing. But when we then see what happened after this COVID-19 hit, look at this increase. It's truly astonishing to see. And just to put it into even more perspective and make it even more visual, if we go and look at all the data back to even before 1970s, you can't really see any bumps. Even during the financial crisis, it's such a small magnitude compared to what is actually happening here in 2020. In fact, this increase in unemployment rate is so big that all the jobs which have been created over the last 10 years has been lost within just 2 months. So if it wasn't bad enough with all this unemployment, if we go take a look at the PMI, if you're not familiar with the PMI, I have made a short video about that, and there will be a link right about now in the top right corner of this one. The way that you read PMI is a reading below 50 means that the economy is shrinking or there's deterioration. A reading above 50 indicates that the economy is growing. And as you can see here, the drop from March to April from 48 and down to around 36. We have never seen such a big drop. If we then expand this, just to put it into perspective, a drop of more than 10 points, you have never seen that before. So this is truly alarming news for the economy as well. And this is not just happening in the United States, this is all over the world. So if we switch from the manufacturing PMI and then to the services PMI. So here I'm looking at Germany services PMI just to have a look at Europe as well. We can see that we were already at a pretty low level in March, but in April this is truly astonishing. We have never ever seen this in the history before. If you try and expand, so we're not just looking at the last year. Look at this drop. Nothing comes close. You can barely see that we had a financial crisis in 2008 and 2009 when you compare to these numbers. I will of course include a link in the description below so you can go in and see all these economic indicators for yourself. Otherwise, there's also a link in the description for the specific video about the PMIs. On a more positive note, it seems like the economies are starting to open up slowly. And when we look to these numbers here, we are still seeing an increase in the amount of dead people and the amount of confirmed cases. But this looks much more linearly than exponentially, as we saw in the beginning. So even though it's still horrible to look at these numbers, it is not as bad as it was in the beginning. And one question that many people are going with these days are, how long will we have to deal with this? And I do not have the answer, and I really doubt that anyone has that answer, except saying until we have a vaccine and until we can mass produce it. And that's probably going to take longer than we would like to, since everyone would like it yesterday. So that was just a brief overview of some of the international news, which I think is highly important when you're looking at it from an investment perspective, looking at unemployment rates, PMI numbers, and the COVID-19 situation. Of course, there is a lot of other news there, but just to highlight some of the facts. Now, let's take a closer look at my portfolio and see what has happened within the week. So as always, the first thing we notice is there was a green circle for this week's episode. That means that my portfolio is up in value. And compared to last week, we can see that the value is $400 more since last week. I'm actually cheating a little bit here since I have added $250 into the portfolio. so the actual capital gain is only $150, but nonetheless an increase. So the $250 that I have invested is a mixture of dividends, since I received close to $30 in dividends from CVS Health Corp. So that brings the total amount of dividends for this month so far up to $36. So $30 in dividends, $220 in additional capital, and those $250 went into Cardinal Health, bringing me to a total investment of $1,000 into that company, and they are actually up just slightly in value since I have invested, so that is of course always great. So let's take a closer look to some of the news within my portfolio, since in the last 16 episodes I have mostly been talking about news in a global sense, or macroeconomic news, and it would of course be very natural to ask the question, shouldn't you be focusing more about the companies within your portfolio? And of course I should do that. So that is what we are going to do now. Since there has been a Q1 report for Suncor Energy, and they are beating the estimates, that is of course great news. But if we are then taking a look at this news, that is really disturbing for me, since they are cutting their dividend by 55% after 18 years of consecutive annual dividend increases. Oh boy, that is not good news for an investor like me. But I mean, when you are in the oil industry and the oil price is what it is and the demand is so low, there's not really much they can do in this situation unless they are willing to take on debt just to pay you dividend, which is also a bad decision if you ask me. And if we read a little further into this newsletter, then we can see that the CFO says that they expect to increase their debt by more than 10%, since they currently have around 20 billion in debt, and they expect to grow it by 2 to 3 billion this year, but they expect to be cash flow even in 2021. And of course, they say that this really depends on when people start to travel again. So basically when the economy will be open. So there is of course a lot of uncertainty here. If we then move to the next news item, Disney will forgo their H1 dividend payments. Since Disney is usually paying out dividends twice a year, this is of course not a good email to receive as a dividend growth investor, and it comes as no surprise that the stock was falling when this was announced 5th of May, and we can see that the stock was down 2.4% when this was announced. So this could of course lead one to say, should I sell the company since they are holding back the dividend payment? However, I think this is a very short-term thing, since they were forced to close their theme parks and their cruise lines, and we are seeing that they're starting to open up some of their theme parks. We are still seeing growth in this Disney Plus channel. So I think it's the right strategy to preserve the capital for now and potentially pay out an extra dividend some point later in time. I will definitely keep on to my stocks for now. The reasons for why they have decided to hold back on their dividends is of course their Q1 result, where non-GAAP EPS was missed by 30 cents per share, meaning that it was actually halved compared to the estimates, and GAAP EPS was missed by 47 cents per share. If you're not familiar with the term GAAP, that means generally accepted accounting principles, meaning there's a general set of rules that you need to fulfill when you are reporting these earnings per share. It is a way to make sure that you can compare different companies in different industries. So most companies decide to report non-GAAP and GAAP EPS. If we then look at the revenue, we can see that they beat the revenue by more than 500 millions. This is due to the fact that they were capable of cutting so much cost by furloughing a lot of their employees. Then we are seeing a huge increase in their Disney Plus subscribers. So this is really a positive news when it comes to the Disney stock. And if you're not familiar with GAAP earnings, then it's probably because you have never invested in the United States or that you have mainly invested in Europe, because here we're using International Financial Reporting Standards, also called IFRS standards. If we then move to the next news item within the portfolio, we see that Realty Income Corp reported FFO of 88 cents, and that beats the estimate by 3 cents. And if you are not familiar with the term FFO, that is funds from operations, since Realty Income Corp is a REIT, which is a real estate investment trust, there you do not report earnings per share, there you report funds from operations, or FFO. So we also see that they beated the revenue by close to 17%, so that is of course also really great news for this company. So if we go and take a closer look of the more detailed description from Realty Income Corp, we see that they were capable of collecting 82.9% of the rent for April. Within the dividend investing community, there has been a lot of talks about how much of the rent which was in danger due to the different tenants that they have, since they are renting out to different fitness centers and other store types which were forced to close due to this pandemic. So this is actually really positive news in my mind, that they were capable of collecting so much rent. And equally important, we see that the revenue is increasing, since they beat the estimate by close to 17%. We see that they have invested more in new properties, they still have a lot of cash at hand, and they still have a lot they can draw from their credit facility. So it doesn't look like they're going to go out of business anytime soon. And we can also see that they have withdrew their guidance due to the uncertainty for this pandemic. And one line which is very important to note here is including 165 million in 4 properties in UK, since now they're not just expanding in the United States, they're actually going out to a broader market, and if they're capable of doing so successfully, then there is a lot of room to further grow. If we then move on to the next company, LTC Properties has also announced their Q1 result, and they have missed their FFO by 1 cent, and they are increasing their revenue by 2.1%. If you also take a closer look at LTC's Q1 result, we saw that FFO is declining on lower joint venture income and on higher general and administrative expenses. And in the press release, they didn't mention anything about COVID-19 affecting the company's operation. We saw that revenue is increasing due to a rental income increase. Then there was also interest income from mortgage loan which rose. Then there was general and administrative expenses which also rose. Then there was income from unconsolidated joint ventures which sank. Then they have received liquidation proceeds of 17.2 million from a sale of properties in unconsolidated joint ventures, and they are anticipating to receive an additional proceeds of 1.3 million and expects to recognize a loss of liquidation of unconsolidated joint ventures of approximately 0.6 million in Q2 related to the dissolution of a joint venture. So this was just to give the highlights of the Q1 report from LTC. I will of course include a link in the description below for the complete report, which is shown here. So if we then move to a completely different news, Ford COO buys more shares. So why do I highlight this? If multiple insiders are buying in a stock which you hold in your portfolio, and in my case I actually severely down on, then you should perhaps consider investing more, because when the insiders are buying, the company is not going out of business anytime soon. There is no one in the world who knows the company better than the insiders. So if they are willing to risk their own money, or risk even more of their own money I should say, then it would probably be a good investment. So far I have only seen the COO buying stocks, but if I see 3 people more or something like that buying more stocks, I would definitely consider to invest more here. So that was a lot of news within the portfolio for this week. I have updated Disney with removing their dividends. I have updated Suncor Energy by slashing the dividend by 55%. And then I have, of course, also updated Carnival Corporation. It's not officially announced yet, but I do not expect to receive any dividends from this company anytime soon. So that was all the news within the portfolio. Now let's take a closer look at some questions from the audience. So questions from the audience. After episode 16, I received this question on the video. Thanks for the video. Can you tell us what happens if a company delists from Wall, for instance, or for example, DO stock? If somebody have shares of the company, have they zero share now? And my reply goes like this: you're most welcome. I don't know anything about diamond offshore drilling, also known as DO in the ticker code, so I can only give you some general statements. If a company gets delisted and filed for bankruptcy, then your shares will most likely be worthless depending on the liquidation value of the company, since creditors will be paid before shareholders, and more often than not, the liquidation value will not cover the creditors. It can take years before cases like this are solved. There is, however, exceptions, companies that actually have a higher liquidation value than share price. In that case, you will gain from the liquidation. And to find more information about delisting, please see Investopedia terms delisting. So that was all the fun and entertainment from the stock market in this week's episode of the Lazy Money Game. So remember to comment, like and subscribe, and until I see you next time, bye!